Hello and good morning, everyone. Welcome to Grant Thornton's webinar on ECL modeling as per accounting standards. This webinar shall be first in our series and shall be followed by a detailed masterclass as well, wherein we will discuss most of the concepts in more detail. As we all know, ECL as a concept, it originated as a response to the global financial crisis. And, where balance sheets of the banks, they were really left wanting for a cover against the expected or incurred but not yet reported credit losses, as we call them. In the Indian context, RBI has played really a pivotal role in defining policies for creation of reserves or allowance against the credit losses. Now, such policies have evolved over a period of time, but they still remain prescriptive. At least for the banks, they remain prescriptive. But for the NBFCs, adoption of Ind AS in 2019, that brought the accounting framework for credit loss provisioning at par with the rest of the world. Now, a lot has changed since 2019. We have seen the pandemic. There has been inflation, global inflation. We have seen wars still going on. But in India, there's been a period of stable economic growth. And the impact of all of this on ECL modeling over a period of time, we at Grant Thornton, we have seen, observed, advised. We have captured all of these experiences. And what we intend to do as part of this webinar is to present a summary of that to you in a very practical way to talk you through some of the complexities that we have seen and some of our own insights, around that, how you can go on and tackle some of those as you drop your ECL provisions. We're also speaking in the backdrop of a discussion paper that RBI had released, early last year, early 2023, where it laid down its vision for the adoption of ECL norms for banks. Now, it is not clear if and when such norms shall be enforced, but the trajectory of the regulatory developments in the past couple of years, if we see, where RBI has come up with, regulations similar to IFRS or Ind AS for the asset side, of the balance sheet, the investments and the other portfolio of the balance sheet. All of that indicates that I believe it should more be a matter of when and not if. And therefore, today's webinar is equally relevant for the banks as it is for the other financial institutions, NBFCs in more particular. What we'll do is that we'll begin with setting the context around the overall state of our economy, of the Indian economy, in terms of credit demand, some of the emerging trends therein, and then we'll spend bulk of our time in today's webinar decoding some of the, what we call as nuances of a typical ECL model under Ind AS 109 or IFRS 9, focusing on complexities, as I mentioned, that we have practically seen, particularly over the last 5 years since 2019 when Ind AS came in. We'll also, in the end, introduce you to a platform that we have created for a self-assessment of your ECL model so that you can see where you stand, where your organization stand in terms of its maturity of, ECL, models. So stay tuned, over the next hour or so, as we take you along on this, what I can call as a roller coaster journey of ECL modeling. Right. So very quickly, what you see on the screen, some of this data has been sourced from the recently released State of the Economy report by the Reserve Bank. And what we can quickly decipher from this is that 2024-25, the coming financial year, the likelihood of the Indian economy being better is there. We can see rising sentiments across various sectors. Infrastructure clearly leading the pack with almost a 90% optimism, reflected by the responses that RBI gathered in its surveys. However, contrary to this upsurge in this business sentiments, the credit demand we see is expected to remain stable. Even though in 2024, across the quarters, it was volatile, but we expect it to remain stable. But that also means that how optimistic businesses are about the growth opportunities, but having a very, what we call as a cautious optimism in terms of, their outlook for borrowings. We always hear the investment cycle playing out, in the coming 5 years. This year is relevant also from other perspectives, political perspectives, and therefore we should see some shifts and stability in trends as we move into 2024, 25. Moving on, in terms of the credit trends, as we see, if we look at NBFCs in particular, I think the good news is that the balance sheets remain stable. If you see on the right-hand side, CRAR, that is between 27 to 28%, which is far exceeding the regulatory minimum norms. It reflects very strong capital adequacy resilience of the Indian NBFC sector at the moment, and which is also reflected in some of the other metrics that we see on the left hand side, which is the GNPAs and the return on assets, all of them showing a much positive trend. GNPA declining from over 7% in December 21, of course, in the backdrop of the pandemic, to about 4.5% now in September 23. That definitely signifies very effective credit risk management, improving asset quality for the NBFCs. On the other hand, the net interest margin and return on assets, they stand strong at 5.1% and 2.9% respectively. They've remained stable throughout 2023, and that's what we expect to reflect in 24-25 also. And therefore, what we collectively see is a picture of sound financial health. And I'll come to one or two trends maybe in the later slides around that. But sound financial health overall, prudent risk management practices that NBFCs have adopted, and a very high level of consistent operational performance by the sector as a whole. Moving to in terms of some of the trends that we see, and I'm focusing on NBFCs, here in particular, is the split between the portfolio from a security point of view. So the exposure in unsecured loans that has increased, over the last several years. As we can see, it's moved up from about 24-25% to almost 30% now. I think RBI has also been conscious of that in the recent past and has indicated policy shift, in that regard. That is where the market dynamics have also been shifting. The NBFCs are realigning their lending strategies, to meet this evolving consumer demand. However, this also, potentially could raise concerns about the credit quality. We have seen a cycle of, over the last decade or so, of cleansing of the bank balance sheet, resulting from the corporate lending side. What we definitely do not want is a similar experience playing out on the retail side. So what we see as a rising trend from an unsecured lending point of view does indicate that the NBFCs need to clearly focus on strong risk management practices, develop very resilient, modern, dynamic models to address credit loss provisioning, and make sure that they leave adequate cover on their balance sheets to withstand any potential exposures in the future. Next, just to sum up from what we discussed in terms of trends on the credit side and the strong balance sheets and everything else, every ratio, GNPA, net NPA, as we saw, that is indicating improved credit risk management. Now, that's also better underwriting standards, advent of technology, analytical, tools which are available today, a lot of machine learning based models, which is providing a whole host of data, to underwriting teams. That's all reflecting. And that also boosts the investor confidence and, enables the NBFCs to expand with potentially lower provisioning needs. On the sectoral side, as we see, as you can see, the commercial real estate is showing a little bit of an uptick in GNPA as compared to other sectors that demonstrate the heightened risk. And within the retail side, the vehicle loan segment, we have seen an explosive growth on the vehicle sales. Very recently we saw the double-digit growth on a month-to-month basis in vehicle sales, but also that is showing in terms of a higher GNPA ratios for the vehicle loan segment in particular. So while there is a overall decline in the NPA ratios, that's encouraging. The sectoral disparities certainly highlight the need for a tailored risk management approach to address some of these challenges. Some of the again key trends. The previous data that you saw was sourced directly from the RBI report. What you see here is some of the analysis that we have done based on the top 20 NBFCs as they are ranked by their net worth. So as you can see, it has the overall ECL coverage has declined, steadily from 4.45% 2021 to 3.42%. Now, that's also the base effect is there. There has been a also credit growth in that period. So the denominator has correspondingly increased, leading to a decline in this ratio. But on a stage-wise basis, also, if we see the stage 1 remains almost consistent at around 1.1% mark. Stage 2, that's been between 7.8 to 9.18. That's the kind of range that we have seen. So off late, there has been a slight increase on the stage 2 side. And same goes for stage 3. Now, that definitely underscores the higher credit risk associated with the non-performing asset. And the banks have been, or the NBFCs have been actually responding in terms of, accounting for those losses accordingly. In terms of the ECL allowances, as we can see that except the stage 1, stage 1 has had a negative, stage 1 has had the positive growth in the absolute ECL provision number versus stage 2 and stage 3, where we have consistently seen a negative growth in the absolute number of ECL provision. Now, a positive outlook around that could be that there is a steady increase in or improvement in credit quality, which is reflective of that decline. But cautious, on a cautious note, as an accountant and as somebody who understands the sector, and understands some of these nuances, I would say the increase in stage 1, a very high positive increase in stage 1, could also potentially mean what we could see 1 year or 2 years down the line for stage 2 and stage 3. So that's the cautious note, I would adopt. And moving on, I think this is just a summary of what we have seen. The ECL expense remains relatively stable. There's a minor negative growth on an overall basis, but relatively remains stable. And therefore, this is now a perfect segue for us to understand the nuts and bolts of ECL modeling. This is what the state of the Indian economy, as represented by RBI's report, and as further validated by what we have internally done based on our own analysis. But let's now understand some of the practical experiences that we have had around various aspects of ECL modeling. And let me now invite our ECL modeling expert, our global leader on ECL modeling, Jatin, to take you through the next 50 minutes. We'll take your questions also in between, and we'll definitely try to get back to all of you in writing if anything remains unanswered. So Jatin, very warm welcome to this webinar, and over to you.
Thanks, Siddharth. So like Siddharth mentioned, we are going to do a deep dive into ECL as a concept and some of the nuances, some of the practical challenges that we have seen the industry face with ECL. So starting with how it all happened, FY 2019 is when NBFC sector had to adopt ECL. ECL is a completely new concept, very recent thing which has come out post the global financial crisis. It came in IFRS through IFRS 9. We adopted through Ind AS 109. What this did was the incurred credit loss model, which was there earlier. You had to wait till a credit loss event had happened and then book provisions in reaction to it. So it was more of a reactive model. So if things becomes bad, you create more provisions. And that's what happened in 2008, 2007, when things were bad for the mortgage market, especially in the US. The banks created provision, but a bit too late. And, till that time, things had already gone, to a level where it could not have been repaired or no one could have done anything. A couple of banks, actually liquidated also at that point. So in response to that, regulators and standard setters said, we need a more expected credit loss model, a model which makes you predict how the future is going to be, which makes you consider how the current economic conditions are, the different macroeconomic situations which may be developing, and create provisions which give you adequate buffer in those expected scenarios. So it goes a lot beyond data modeling. It goes a lot beyond looking at your past data, and you have to do a lot of predictive economic analysis as well. So that was a big change which happened. But that, of course, was a big change internationally. For us in India, it was an even massive change because we were never really on incurred loss model also. When we adopted Ind AS 109, we were following the RBI prescribed rates. So it's kind of like, you have a son, he skipped school completely, and you send him to college directly. So it was that kind of a scenario for us, NBFC specifically in India. And that's the situation we are looking for banks also in India. Directly going to Ind AS 109, directly going to a forward-looking expected credit loss model. Now, not that we did, terribly after getting that challenge. Siddharth, myself, and the team here has, of course, worked with organizations across the globe. We actually have, individually also worked with organizations in 6 different continents. Antarctica is the only one left. But what we can say is that the practices that we have in India are definite, while not the benchmark level, but definitely we can be proud of what we have achieved from where we started. There are issues around model monitoring. There are some challenges which are developing, which we'll talk about later, but it's a strong base that we have achieved in a short period of time, despite the challenges which we had. Okay, so ECL, where all do you have ECL impacting your portfolio, your balance sheet? It goes on all of your financial assets, which are at amortized cost. For a bank, for an NBFC, primarily what you're talking about, of course, are loans receivable, loans and advances which are given. But then it's also there on, debt investments which you make, any intercorporate debt, any financial guarantee, any off-balance sheet credit exposures, all of those things also. Also loan commitment. So yeah, I mean, a lot of financial assets which a bank NBFC would definitely have, ECL impacts all of that. Now, what we are going to talk about, we have, of course, a limited time in which we want to cover the complex topic of ECL. So we are going to cherry pick some of those issues which we believe are the most, dynamic at the moment, which are having the most amount of impact on success of your ECL journey. And the couple which we are going to talk about first are what matters the most from a design of ECL model perspective, So oftentimes we hear that some companies say my ECL results are not reflective of my judgment, of my management intuition. I believe my ECL should have been lower in this period. It's coming out to be higher. I believe my portfolio has improved, but my ECL has also improved. So why is it that, my ECL results are not reflecting what's actually happening in my opinion to my organization? And when we do those reviews, when we try to understand what's going on in the ECL model, oftentimes what we find is that the design in itself is not optimal, And when we talk about design, the 2 things which matters the most are first, the segmentation that you have done of your portfolio to start with the ECL modeling journey. And second is the staging criteria that comes. So first, we're going to talk about segmentation. But what we are saying here is that there are certain influences for credit risk, right? So let's take an example. Let's say you have a portfolio. It's going to get impacted by how certain industries perform in the future. Let's say you have a lot of, dependency on agriculture industry or tourism, or certain kind of industries have dominance in terms of credit risk for your portfolio. Now, if I don't bifurcate my portfolio based on those variables, then ultimately the model I'm going to create is not going to have the right influences, and therefore, not give the right prediction, not give the right results. Segmentation is all about including those variables for determining credit risk, which we believe has a strong impact on credit risk of my portfolio. And this is where what we have seen is that when people started, of course, they started with very, standardized kind of approach for segmentation. okay, look at products, okay, look at secured, unsecured. But now as people are evolving, now as backtesting results are showing that ECL hasn't really been up to the mark for some of the predictions, what they are identifying that there are other variables which are more useful for doing more predictive analysis. Segmentation becomes a key area of focus. The challenges specifically in NBFC industry, also a lot of fintechs and all who are starting to get exposures, what we see is adequacy of data, right? For doing segmentation analysis, for doing modeling, you need to have adequate amount of data, you need to have history, you need to have certain defaults so that you can do all of those analysis and create predictions. That may not be available. Another thing that we see is that it's very dynamic, currently, based on my underwriting, based on my credit risk exposure, certain segments might make sense. 2 or 3 years later, you would realize that it needs another change. The other challenge that we see is, how do you test discriminative power? A lot of times earlier, people used to do a qualitative assessment to determine, okay, whether segments are, something that you should bifurcate. But now there are statistical tests which people have started to employ and they're getting results out of it. So insights from our side is one, of course, planning ahead. Currently, you do not have adequate data, but how do you create the systems? How do you create the processes so that you can get data be available for you 2 years, 3 years down the line, and then, better your ECL models from a prediction perspective. Second, if you don't have data, there may be certain techniques from a variable transformation perspective, data boosting perspective, which may help you, utilize the data still. Again, there's a lot of statistical background in terms of how you may be able to do it, and there are situations in which different techniques would work, but certainly something that should be explored. And the third thing, of course, is use of more advanced behavioral variables. Use of spending patterns, use of utilization limits and things like that, which can really help you identify behaviors of customers and thus help you determine which are the segments that you should bifurcate your portfolio into. Moving forward to the second thing, which is the SICR criteria or the staging thresholds. Now, first thing which everyone thinks of when we talk about staging is that, okay, stage 2 is anything which is 30 days past due. Stage 3 is anything which is 90 days past due. And that's very much like, how we used to look at things before, which is that you have a particular DPD threshold and a very rule-based system of determining what stage a particular loan is into. But IFRS expectation, of course, is quite different. The 30 DPD and 90 DPD criteria, as per IFRS, should be looked at solely as a backstop indicator. So it's like, the last resort to identify loans which are going bad. The thing is that you should have a lot of qualitative and other indicators which can help you identify, any problems that the loans may have a lot sooner. And only in case all of those checks have failed and, somehow, you were unaware that things were going bad, then upon 30 DPD or 90 DPD, you ultimately move it to stage 2 and stage 3. And that's what we are seeing a lot of organizations now bring more and more into practice, including additional criteria beyond the 30 DPD, 90 DPD criteria, including those other criteria which can help really reduce volatility also, help, bring more in sync the information that you bring from an ECL perspective and what's going on in the business. But then this, of course, is not a very easy thing to do also. You may have a lot of different things which may happen in the economy or for your portfolio, and you have to determine whether it creates a trigger for you to do a stage downgrade. For example, we saw lockdown affecting certain industries disproportionately, which means that, of course, if you have industry data identified for your customers, you can really see which are those customers which may be impacted because of the lockdown, which of course happened at that time. We may be looking at housing market correction sometime in the future, maybe. When that happens, who are those customers on your book who may actually get impacted? We may be looking at a significant slowdown in China. There might be certain customers which may get impacted because of that. And of course, commodity prices, you always have volatility, you always have cycles. Which are those customers, which are those segments where this can have, this could be included as a trigger for you to, evaluate if a significant increase in credit risk has happened. One thing which we see a lot internationally, but not so much in India, is inclusion of criteria for absolute and relative change in PD when it comes to the SICR definition. Like I mentioned, everyone has 30 DPD, 90 DPD as a criteria, but some of these other criteria are things which people are starting to adopt more and more now. Then identification of appropriate cure period. So a stage downgrade has happened, but now the customer has started paying on time. All dues are, something which are on time now. So do you bring it back to stage one? If so, do you wait for some time and then bring it back? And if yes, how much time do you wait? Right? So that's the whole concept of curing period. How much time do you wait for a bad loan to be brought back to stage one? There's a lot of differentiation practice that we have seen. Regulators in some of the countries have started giving prescribed periods for this. We have an expectation that RBI may also come up with it when the banking guidelines come out. But at this moment, of course, there's no definite guidance. And we see a lot of mixed practices here. Some people have zero cure period, some people 3 months, 6 months, 12 months. It does depend basis the nature of portfolio also. But yes, this is an area which definitely is dynamic at the moment. People are seeing changes here. And then, of course, doing a lot of scenario analysis, stress testing can really help you. If your models are, enable you to do all of those analysis, it's recommended you do that so that you see what the impact of certain scenarios could be on your portfolio. And accordingly, that helps you in more realistic macro forecast. Okay, so that was from a design perspective, segmentation and staging criteria, designing it well can really help you have more reasonable ECL results. Now let's talk about the models. And as all of you would probably know, when we talk about ECL, we talk about 3 models. You have the probability of default model, how many customers would default in the future. You have the loss given default model, which is for the customers that do default, how much is going to be the loss. And third is the exposure default models, which primarily is determining what the exposure is going to be on that possible future date of default. EAD, of course, is more complex when you are talking about limit-based facility, credit cards, things like that, where the balance can go up and down depending on utilizations. So you have all of these models, and there's, of course, a lot of theory and practical things which are there, which, we go in detail as we do our future sessions, like Siddharth mentioned. But the 3 things which cut across as challenges across all of these models are the ones I mentioned here. One, large amount of data modeling, handling vast amount of data, which always is not going to be perfect, right? So it's not just handling that data, it's also cleansing that data, pre-processing, and determining how do you really treat it to make it usable data. There's going to be data quality issue. There's going to be inconsistencies between the data as, you would have changed your underwriting policies or rating methodologies or whatever. So how do you handle all of that? The second thing that we have seen as a challenge is enabling technologies. Of course, 2019, when people started with ECL, a lot of them, did a mixture of Excel-based models with some amount of programming on Python or SQL or whatever to get some of the tables which they can use. So it was really, ad hoc, and it was really, I would say, not something which you would call permanent or very consistent way of doing it. And now, of course, larger NBFCs, larger organizations are looking at creating more sustainable technology, which can help them, have more robust result, and also better analytics around how ECL is changing and, help in the decision making also. Excel-based tool can give you an answer, but it may not really aid your decision making or give you a lot of analytics around how, what happened in your portfolio in the previous periods. And then third, of course, is cross-functional coordination. All of this data comes from a lot of different teams. You would want collections data which may come from one team. You would want data on, early warning signals or, leading indicators of stress, which may come from another team. You would have a lot of finance data like EIR and all, which you need for discounting. And then, of course, the IT needs to support from a LMS perspective in terms of getting all of the data in one place. So it's a coordination between a lot of different departments, which is challenging, but also very essential for a good model. But the key area that we are going to focus on now are the macro models. The most subjective, the most complex probably among all of these models are the macro models. And what I mean by macro models is, how do you make ECL predictions which are as of today? Now, what I have in the chart here are through the cycle and point in time PD, a graphical representation of that. Through the cycle PD is the long run average. For this organization, it's 5%. So 5% is my long run average PD. But the point in time PD, which is what you ultimately end up using for ECL, is something which goes up and down. If you are in a bad period from an economic cycle perspective, the PD would be higher. It may go up to 8%, 9%. In a good period, it may go down to 1%, 2%. So what I mean by macro model is translating the TTC PDs to PIT PDs, translating that flat line into that up and down line. And that, of course, is really subjective, really complex. How you do that? You, of course, have to look at, identifying what kind of economic circumstances are there as of now. You have to look at what the forecast is for the future in terms of, macroeconomic variables and stuff. And then have a model which can, utilize all of the data to give you appropriate predictions. So ECL estimate, like I mentioned, is historical loss experience plus effect of current conditions, and then also forecast of future economic conditions. How do you do it? So you start with looking at the historical information you have. You look at evaluating correlations between that historical data, historical default data, correlating it with the macroeconomic factors. You may believe that unemployment rate has a big impact on your portfolio, or GDP does, or inflation does, or oil prices, or commodity prices, whatever that right macroeconomic variable for you is. Evaluating correlations between them to identify which are the factors which are really impacting your portfolio. And then adding it with some qualitative evaluation, qualitative factors as well. Then developing a range of different scenarios and assigning probabilities to those scenarios. There might be a bad case scenario, in which, let's say, housing market has a decline in prices, things like that. There might be a good case scenario, different scenarios. So then you do a probability determination, that how much probability is there of different scenarios happening. So that's the typical approach. Of course, there are different models we're going to talk about which can help you apply this approach. The key challenges which we always see is at what level do you, include the forward-looking information. We spoke about segmentation earlier, and here also it plays a very important role. If there's one particular portfolio which is more impacted by one variable, then of course it should be looked at in that sense. And then if there's another portfolio impacted by another variable, you should have a different macro model for that other portfolio. So you should really look at what amount of bifurcation you have, what amount of influences macroeconomic variables are going to have on the different parts of your portfolio. Another key challenge is the issue of non-linearity between expected losses and the economic conditions. And there, of course, transformation plays an important role. The judgment of the modeler needs to come into play so that you are able to adjust for all of those issues and then, still have a model which works. And then, of course, identifying what is the most appropriate model for you. There are certain choices, and you have to decide on which one really would be good. For India, of course, weak statistical correlation is a reality. We have had a pretty dynamic period with the demon, with the COVID lockdowns and everything, we have had macroeconomic variables which have gone up and down. And in that scenario, of course, doing correlation analysis becomes challenging. But things have become better. There's more knowledge and experience now between people, and they are able to adjust for some of those things and help you still get decent statistical correlations. Adapting models, utilizing more qualitative data and variable transformation, of course, are examples of what can be done. But then, of course, there will always be a certain possibility of rare shock events, which models would never be able to model. And what that means is, needing possibly overlays in sub scenarios, which of course is also a reality that we have seen. Choice of model, what kind of macroeconomic or forward-looking model should you have? A lot of people, of course, use logistic regression. That's been there for almost decades now in terms of theory, or the most common approach to do this kind of a modeling. Time series regression, of course, can help you recognize temporal dependencies, work out some of the statistical issues that the data might have, and then help you in better predictions. You have an option of AI/ML models, but currently for financial reporting purposes, it's not in use really in any of the developed economies also. The reason, of course, is ECL is supposed to be auditable. You have regulators, multiple stakeholders look at it. And AI/ML models, while may be very useful from a decision-making perspective, may not really be the most auditable from an audit trail and from a understanding perspective. But of course, I mean, you can really look at this being a challenger model and a move towards a AI/ML model as things develop further. But then, of course, when things started, a lot of people did Vasicek model, the Basel formula for determining what the correlation is and everything. Might be too basic, but still at least better than pure judgment. We are seeing like every year there are few NBFCs who are now transitioning from a Vasicek model, which they started with, to a regression-based model, because Vasicek model can be very volatile, can really result in results which may not make sense at certain times. And then for certain types of portfolio, Monte Carlo, similar type of simulation is really required. If you're talking about, let's say, a fintech which is given a second loss default guarantee, if you're talking about a portfolio level credit enhancement which is given, things of that sort, then you really may not be able to manage with other models. You would have to look at a simulation based model. Okay, so we have a question for you now. Actually, there are a lot of questions in the chat also which we'll answer, but here it's us asking a question. You would probably get an option to select your answer here. Would be good to hear your thoughts. What's your biggest challenge regarding ECL model? We'll give it another 10 seconds for everyone to answer here. Okay. Still getting some responses, but yeah, I think we can move. Yeah, so here we have the results now. Okay, very interestingly, it's a mixed response. I think all of them are challenges, but the two which are becoming, two which are getting the most number of votes. One, of course, is ECL results are not accurately predicting losses. I think which brings us to the first point which I mentioned, which is that you have an intuition in terms of how the result should be, and then you have the result from the model, and they are not in sync. And second, of course, is how do you set up a robust model monitoring framework? That's, of course, the next step from an evolution perspective, and very much something which that definitely is a challenge. And that really, brings us well in terms of the next slide that we have. We spoke about model monitoring. How do you set it up is something which people are not clear about. And that's because when we talk about model lifecycle, right? Model management 101, there are four phases of a model lifecycle. You have model development. Once you have done model development, you go into the model monitoring stage. And then you have model validation. You would have some frequency of getting independent model validation. And then, of course, model maintenance. If there are some non-modeled risk, how do you create overlays or deal with that? Where it is for Indian NBFCs, at least at the moment, is that everyone did model validation really well. They engaged the best of experts. They got the model, they did the model development work very well, right? They spent time, effort, created models which they were happy with, but then never really spent focused on the other elements, which are model monitoring, validation, and maintenance. And model monitoring, honestly, is something which is critically important. That's something which is the focus of a lot of regulators across the globe at the moment. A simple example of this, of course, is backtesting, which is to say how accurate were your models in terms of predicting last year or last period's results. But it goes quite beyond that also. It goes to, it sets up as a framework to determine whether there's any significant model drift in terms of, when you set up the models, you had certain parameters, you had certain assumptions. The current portfolio, is it drifting away from those? If yes, the model monitoring can set as a, platform where those get identified and you have adequate insights to make decisions. It also is really useful for you to understand what happened, right? It's one thing to say that, okay, my ECL was 10% higher this year, but why was it higher? Was it because you had certain macroeconomic shifts which caused stress on your portfolio? Was it because there were some underwriting policy changes? Was it because there was some, single event which happened which really caused the stress, or collection recovery channels had some issues? So it could be a lot of these different things which can cause those, the variances to come in your ECL results. And monitoring can really help you identify what those what those reasons are, and they can help you in the decision making and determining how do you look at models in the future. So model monitoring is very much something which globally is in focus at the moment when you talk about ECL models. And I've just mentioned here some of the tests, some of the properties which you generally look for testing in a monitoring framework. The best practice, of course, is doing these monitoring tests on a quarterly basis, having thresholds, having limits, acceptable limits of all of those tests, so that in case any model drift is happening, any results are out of range, it promptly gets identified, and you have an opportunity to address them. There are a lot of different issues which can, of course, be looked at here. So yeah, that was on model monitoring. Now, would be good to hear thoughts on model validation, right? The best practice, of course, is that model validation happens once in a year, once in 2 years, and it is done by someone which is independent of the modeling team, right? That's what the model management guidance of all the regulators and everyone say. Would be good to hear everyone's thoughts in terms of how do you look at model validation practice at your organization. Again, anonymous. The results are, of course, not displayed at the organization level. Give it 10 seconds for everyone to answer here. Okay, I think we can go to results now. Okay, validation by internal team, outsource, and no formal practice. So mixed here. Um, quite interesting. Like I mentioned, from a life cycle perspective, currently a lot of people globally have moved from model development to model monitoring as a focus, and the next phase is model validation. And we'll see the cycle come into play for Indian organizations also as we move along. Right. So those were some of the things on this. Two issues, and I looked at a question. There were quite a few questions which had come, and incidentally, one question which has come up most often is how do you deal with scenarios where you have low data, right? NBFC is new, the portfolio is new. I don't have a lot of default data. How do I deal with that? That's of course a very significant issue which Indian NBFCs particularly are facing as they're growing. Of course, you would have more data in the future, but as of now, what do you do? That's a key emerging trend. Another emerging trend is the whole issue of overlays, models not really working. So we're going to talk about these two complexities, which we see most often from an Indian NBFC perspective. Sorry. So post-model adjustments and overlays. Now you may have, best of models, but it's always the case that there would be certain risk or certain variables which you're not able to factor in the model. And then, you're left with a scenario where either you can have the wrong results or you have to create a post-model adjustment or an overlay on top of it. The question which comes up very often is it acceptable to have overlays? Should ECL come directly from the models, or is it acceptable for you to create a post-model adjustment and overlay? Is that, is it acceptable, or is that a wrong thing from an audit perspective or IFRS compliance perspective? And the answer to that, which is now fairly well recognized, is that post-model adjustment and overlay is a reality, right? It's unavoidable. Your model cannot take care of all the different variables, of all the different influences from a credit risk perspective. It is, quite likely that you'll end up in a scenario where a post-model adjustment or overlay is required. In fact, the Australian banking regulator recently came out with a notification also. I think it was around 6 or 7 months back, where they came out and said that, yes, we do recognize overlays are going to happen. They're just these things that we want you to ensure from a governance perspective, but overlay is a fact which we do accept. So the answer is yes, overlays are possible. But when you're doing it, of course, it's going to be significant judgment that you're making. And therefore, documentation, governance becomes very important. What we see as best practices here is one, doing a more granular assessment, not doing an overlay at an overall organization level to say that, okay, I'm increasing my ECL by 10%, but really identifying which is that portfolio customer segment where I think overlay is necessary, where I think the model is not capturing all aspects, and therefore I need to create a post-model adjustment. Second, doing a risk differentiation. So is an overlay on PD? Is it on LGD? Identifying, is it that I'm expecting more defaults, or is it that I'm expecting the the losses to be more or less on the defaulted customers that I have today? And post-model adjustments could go both ways. It can be a positive or a negative adjustment. But as I'm sure all of you can guess, most of the overlays which people are creating is to increase their ECL only. Third thing, which is very important, is benchmarking can really help you support the rationale for overlays which you're making. And then finally, validation. Historically, also you created overlays, validating the results of them so that you improve your effectiveness of creating overlays over time. But in escapable reality, it is something that you may have to do. Question for all of you. What is it that you struggle with the most on model overlays? First, is it that you're unsure where to start? You're unsure how to substantiate with external benchmarks and quantitative analysis? Is it the questions from the auditor, or is it justifying to internal stakeholders, like let's say the board or the management? Another 5 to 10 seconds for everyone to answer. Okay. Let's see the responses. Unsure how to substantiate with external benchmarks or with quantitative analysis seems to be the biggest concern. But we do have, we do have responses in all the 4 answers. Pretty insightful, quite interesting. Questions from auditors becomes quite significant, which ideally it should not, be a big concern, honestly. But yeah, I think things are developing. Things are really at a more initial stage from a ECL perspective at the moment. So it may change also. Okay, the next thing is the second challenge which we see a lot in India is the low default portfolio challenge, low data portfolio challenge. What happens, of course, is that, for you to do any kind of models, you need to have adequate amount of data behind it so that you say that, okay, historically, these defaults have happened. These have happened because of these reasons. So let me just include these variables in the model and do prediction. Now, if I don't have defaults of the past, what do I base all of my models on? Insufficient data size, data gaps becomes a challenge. Let's say your systems weren't great earlier. The variables or the data which you captured for your loans, it wasn't perfect or it wasn't, usable. That becomes a big challenge. Unrepresentative data, let's say you were doing different kind of product earlier, then you really changed your strategy, ended up in another kind of customer market or a different kind of product now. So it becomes unrepresentative, the past data which you have. Or it could be that you have limited data for doing model calibration or backtesting or scenario analysis. These are, very frequent challenges which organizations face. How do you deal with them? External credit data, something which is very popular outside India. For example, in UK and in some of the countries, you have data vendors who have specialized in providing data which can help banks and NBFCs predict losses. In India, still it's not so easily available. The bureau data or data that you have at the aggregated level for your industry or type of lending, it may not be very good. Currently in India, it may not be enough for you to create models. So in India, it becomes a challenge, but still, it's something which some people have been successful in doing in India also. So identifying which can be those potential sources of getting the external credit data and utilizing it becomes a really good option. Second, of course, applying some kind of statistical techniques which can help you boost the limited data that you have. So one technique which, as an example, I can share with you is that defaults generally are loans which are 90 days past due. So instead of 90 days past due, substitute 30 days past due as a criteria for looking at your historical loans and then calibrating it later. But at least using that 30 DPT criteria, you have a model, you get some results, and then you can calibrate to bring it 90 DPT again. So you can use some of those statistical techniques. Industry benchmark, one would say that, for example, auditors would often say that, okay, industry benchmark is not really a ECL model. That's not really you doing what's required as per IFRS 9 or Ind AS 109, but it can really be very helpful. Would really suggest having adequate benchmarking, identifying the right benchmarks and doing appropriate benchmarking so that you're able to do it. Again, a challenge which we see here is the data which is given by companies on ECL in annual reports and all may not really be very useful, which is different from how it is in some of the other countries. In some other countries, the disclosures which the regulator requires are actually very detailed, and then you can get, okay, what's the PD, what's the LGD, which is observed by different organization. You have pillar 3 disclosures, you have different types of disclosures which may take into influence what the ECL models have given out, and that can be used as a benchmark. In India, again, industry benchmarks is tricky because you don't always get exactly what you're looking for. You might have to adjust the GNPA ratios, net NPA ratios, adjust all of those things to get useful insights for your portfolio. And lastly, of course, identifying regulatory proxies is something which people have done, especially for LGD and CCF in cases where they don't have their own data which is adequate. Okay, so a question here: what do you find as the most critical concern regarding low data portfolio? So I think I've seen quite a few questions on low data portfolio. So it would be good to hear which is the most critical concern for you as you're talking about low data portfolios. So priority, you can rank it by that. So whatever you say is the first most important one, you give it column 1, second most important column 2, and 3 and 4 in that manner. Okay, another 5 seconds and then let's look at the results here. Perfect. So if we talk about column 1, reliability of judgment used in low data models is something which people have said is the most critical concern that they have seen. Judgment which gets used in low data models becomes a significant concern. Then validation of model assumptions, regulatory compliance. People are unsure if it's IFRS 9 models 10, and then of course governance and oversight. These appear to be the biggest concerns amongst people. Very interesting. Perfect. Finally, what is it that we of course have done this almost 1 hour webinar with you. What is it that we can offer in addition to this? And what we would want to offer to you is, first of its kind model maturity assessment tool. So we have this tool called ECL Assess Pro, which we are launching now. Something which, for industry constituents is free to access. Something which has close to around 250, 270 questions from, the best practices and regulatory guidance, which is there across the globe, which can really help you benchmark your models against what the best practices and all is. And also then help you identify which are those areas where possibly work is required, giving you all of those dashboards, giving you all of those action plans in a very automated manner. So let me give you a promo of that. Right. So, ECL SS Pro are offering for the industry. Anyone who wants to utilize this as a primer for identifying where they are in the ECL journey, and where is it that they would have areas to improve in relation to international best practices. Welcome, to register and utilize the tool for that purpose. And apart from that, of course, if there are any queries, anything else, we are available. Like Siddharth mentioned, this is, in our series to have multiple sessions and, follow it up with a masterclass, which can really help more discussions around ECL. Siddharth, over to you.
So thank you, Jatin. I mean, this is, of course, for 60 minutes, this was, quite a roller coaster, quite a, quick paced journey. But as I said earlier, we'll definitely come up with a more detailed, masterclass wherein we can take some of these questions in more detail. There are a few questions, on the chat box, that we can see, and some of them may need. I can promise you that we'll definitely come back to you with written responses, for each one of them. I've tried to answer a few, but others which needed a slightly more detailed response, I have left them open, and those are now in our records to come back to you with. So Jatin, that is my personal request to you, to do that to everyone. And a copy of this presentation shall be available. The assessment tool that Jatin talked about, that also shall be accompanied in the same email or in the same presentation. And we all encourage you to access it. This is all. I don't want to use the word free of cost. I just want to say that this is more of a knowledge building, initiative around this very critical, aspect. We are working with the regulators also to see how we can smoothen out this exercise for the corporates, and therefore your positive responses, by virtue of your self-assessment and any questions that you may have thereafter will really help us in that endeavor. So thank you so much, for joining in today. Jatin, any last words that you want to say, before we part?
Nothing else, but I do again promise that the questions which are there, we'll do respond to each of them. Thanks, everyone.